James Wagner here, and welcome to Banks and Bank Robbers. What happened to savings in America? When you think about it for even a moment, there's not a business in the world that could survive long without making a profit, right? That profit is a company's form of savings that can be put away to keep the company healthy and growing. So to hire people, to grow and to prosper. So why should we as individuals be any different? Don't we need to have a source of money to keep ourselves and our families healthy and growing so that we can prosper as well? In this segment, we're going to be talking about why Americans seem to have forgotten this principle. But first, let's understand this. We need to take a look at the changing role of banks in general. You know, I've been dealing with banks not just during my professional career in finance, but my whole life. As a child, I was always impressed with these large Corinthian columns that surrounded the street fronts of many banks in my hometown. They seemed to ooze confidence. The bank had names like the First National Bank and Trust Company. As a child, I thought the word trust in the banks meant that it was because they wanted you to trust them with your money as being safe from somebody holding it up with a gun or the teller or any sort of bank robbery that would affect your deposited money. Naturally, I didn't know that the Federal Deposit Insurance Company provided insurance against losses of any kind up to $250,000 per depositor, and that for non-interest-bearing accounts, there were no limits. If I'd only known that, I would have felt much better. Well, over the past 2 years since the financial crisis of 2007, the FDIC has been called out to bail out a record number of banks, large and small. With the help of the Treasury Department and an act of Congress, as well as the full faith and credit of the United States government, the system has survived. But when the federal government steps in and bails out our banks, we, the taxpayers, are the ones that have to pay for the bailout. But just how does this work? The answer is that we pay in several ways. First, the FDIC receives part of its funding from insurance premiums that banks pay. So, if the FDIC insurance pool is depleted because of unexpectedly high bank failures, then the FDIC raises its insurance premiums. Okay? Well, to cover these costs, the banks, of course, pass this along in one or more ways in higher fees to its depositors. Ouch! Now that's bank robbery of a different type. In 2008, the federal government stepped into the banking crisis, creating, among other things, the TARP program, intended to lend hundreds of billions of dollars. This, of course, adds to the national debt. Just to give you a little insight into the national debt, as of today, roundly $11 trillion, or more than 130% of what every man, woman, and child in this country earns in a full year, is represented by our national debt. We often hear economic commentators talking about the national debt with a sense of impending doom. But why is this, and what are the implications? Well, to better understand this, we have to first look at the level of debt. In the past, when the debt was a small portion of our income, then we had the ability to pay off our debts from the goods and services that were produced and the taxes that were paid to the government from the income that we made. However, at current debt levels, every person in this country would need to continuously work without any pay from January 1 to April 30th of the following year to pay the debt off. Obviously, this is neither reasonable nor practical. Given the existence of debt, the next question is how to finance the debt. The federal government, of course, issues bonds, and for many years, it's you and I who've been buying the bonds. When the U.S. government began issuing bonds for purposes of financing things, well, like World War II, American citizens were quick to dip into their savings to help the effort. But that is no longer true. America's personal savings rate, defined as savings divided by disposable income, has been falling steadily for more than 2 decades to among the lowest levels of any country in the industrialized world. In the mid-1970s, for example, the savings rate stood at more than 14%. As of 2004, it was a paltry 0.4%. According to the U.S. Commerce Department's Bureau of Economic Analysis, America spent more than they saved in 2005 for the first time since the Great Depression. These and a host of other data point to a disturbing reality. America is experiencing a savings crisis that threatens its economic future. Savings are a source of capital investment in new products and services that increase productivity and contribute directly to economic growth. As domestic sources have dwindled, U.S. business and government alike have had to rely on foreign sources of capital, resulting in a growing outflow of billions of dollars a year in the form of interest and dividend payments. Instead of the world's banker, the U.S. has become the world's largest debtor, with a growing trade deficit and a weakening dollar that threaten a sinking economy, rising unemployment, and lower standard of living. So why have savings rates fallen? There are lots of different theories. Here are three to consider: declining interest rates, easy credit, and something the economists call the wealth effect. Let's start with declining interest rates. After peaking in 1980 to 1981, interest rates began a long decline, fueling the economy by encouraging borrowing and spending while gradually discouraging savings. The prime rate at 21.5% in 1980 fell to just 4.0% in 2003, and the 30-year mortgage rates declined from an average of 16.6% in 1981 to only 4.83% in 2007. Meanwhile, rates on 6-month certificates of deposit slid from a high of 17.98% in 1981 to only 0.8% as of October of last year. Easier credit and ways to borrow. Creative financing mechanisms, including zero-down interest rates only and adjustable rate mortgages, home equity lines of credit, and the securitization of debt, made it easy for consumers to borrow money to buy anything from homes to investment to cars, vacations, jewelry, and the latest digital consumer electronics. The wealth effect. Beginning in the early 1990s, American household wealth skyrocketed as a result of booms in the stock and real estate markets. Now, it's an economic axiom that when household assets increase rapidly, people perceive less needs to save, while their appetites for spending increase. Before putting a cap on this segment, we must mention one bit of encouraging information about consumer savings. During the current economic recession, the savings rate has taken a dramatic upward leap, reaching almost 5% during parts of this year. Obviously, the wealth effect has reversed itself as consumers are restricting spending and putting as much money as possible under the mattress. Also, credit has become far more difficult to obtain and much more expensive as well. However, consumer savings is not being aided by interest rates, which remain exceedingly low. There is no doubt that longer-term solutions are needed either through tax credits or other saving stimulus if America is going to wean itself of debt. What you should know about banks and those hidden fees. So far this session, we've been talking a lot about banks. According to surveys by the American Bankers Association, public opinion about banks has never been lower. There may be lots of reasons for this, such as the high salaries of bank executives, the failure of many banks in the current financial crisis. There are other symptoms, of course, like the public disdain for banks and bankers, caused by that 2-inch thick piece of plastic between you and the teller on the other side of the bank wall. But I believe the biggest single reason is the exorbitant fees that banks charge. In simplest terms, banks are not in business to take deposits and lend money, which was the traditional role played by these institutions. For the past 20 years, their game has been entirely devoted to charging you, and in some cases actually earning them, fees at every possible opportunity. These facts are no surprise to anyone who's paid close attention to the fees that are being taken an increasing share of our wallet each month. However, it astonishes me how little most people keep track of these annoyances. The next observation is that many fees have turned banks into bank robbers. Between low interest rates and increasingly higher fees, traditional savings accounts, including CDs, should be used as a temporary parking space for your money. While most people need to have at least 5% of their assets in liquid form, the cost of keeping large sums of money in a checking account or savings account add up over time. And finally, we intentionally left out any discussion of real estate. Many people look at their homes and income properties as the best form of savings and investment. And we'll cover real estate separately in our next session. But for this segment, just 2 points. First, paying down a conventional mortgage, that is one that includes repayment of principal as well as interest, is a form of forced savings, which works well for many individuals. However, unless you have an untapped line of credit in the form of a second mortgage, a home does not offer liquidity in the event of an unexpected expense. Well, that does it for this time. Thanks for joining us. I'm James Waggoner. Be sure to join us in our next edition when we're going to talk about your home and a few very important considerations about home mortgages, especially in these deflationary real estate times. See you then.